If you're sitting on a home loan right now, paying interest that you can't claim back at tax time, I need to show you something that could change everything. I'm Alex G, founder of Kingfisher Finance Group here in Brisbane. We settle over $100 million in loan applications every single year. And look, most people think that their mortgage is just a bill they need to pay off as quickly as possible. But what if I told you there's a way to turn that same mortgage into a tax deduction? In the next few minutes, I'll show you exactly how to turn your bad debt into good debt, the exact structure you need, and explain who this approach works for and who should avoid it. Let's dive in. First, let me explain what this strategy actually is. It's called debt recycling. Debt recycling is basically converting your non-deductible home loan debt into tax-deductible investment debt. You pay down your mortgage, redraw that money, invest it in income-producing assets like shares or ETFs, or even the deposit for an investment property. Then use the investment income and tax savings to pay down your mortgage faster. Sounds great in theory, but does it work in reality? So let's say you started with a $400,000 mortgage at 6% interest, and you had $50,000 in savings sitting in an offset account. Instead of leaving it there, you can use it to pay down your mortgage to $350,000. Then you can restructure or refinance to immediately redraw that $50,000 and invest it in a diversified ETF portfolio. Now let's say that a $50,000 investment generates about $2,000 in dividends over the year, along with the fact that the interest on the $50,000 loan portion became tax deductible. You might save, say, $1,500 in tax, depending on your marginal rate. That's $3,500 total benefit to put back into your mortgage and reduce the non-deductible debt. Now, there are two ways you can do this. You can go to your existing lender and do what's called a principal reduction. You still go through our application process, but you're essentially restructuring your current loan. Or in most cases, it's actually better to refinance because we can often save you money on your owner-occupied mortgage at the same time. So we go through a refinance application and we say to the new bank, we're going to refinance $400,000 of owner-occupied debt, and we want to release $100,000 to invest. Between the time the refinance is approved and the settlement, you pay that money down on your owner-occupied home loan. So on settlement day, the new bank is only paying out $400,000, and you've got that $100,000 left over sitting in an offset account ready to invest. I worked with a client recently who had received a $200,000 inheritance. Now, instead of taking that money and going and investing straight away, we were able to use that $200,000 to pay down their owner-occupied home loan. So they owed $800,000 on their mortgage. We paid that down to $600,000. We then went to the bank and asked them to release that $200,000 back out as an investment loan. Once the settlement process had taken place, they had $200,000 sitting in a newly created offset account against a newly created investment loan split. And they could then go and continue to invest with their financial planner. So instead of rushing into investing and spending the inheritance money straight away from their offset, they effectively reduced the portion of their owner-occupied mortgage, took that back out as an investment debt, and improved their overall tax position. Now, instead of having $800,000 of non-deductible debt, they have $600,000 of non-deductible debt and $200,000 of tax-deductible debt. The income from those investments can help offset interest costs, and when structured correctly, this is where debt recycling compounds. By directing any extra income into the owner-occupied home loan, you're actively accelerating the paydown of non-deductible debt. Over time, this creates a compounding snowball effect. Every extra dollar that reduces your home loan frees up more equity, which can then be recycled into further investments. Debt recycling worked really well for that client because they had a few key things going for them. They had a lump sum of cash, a stable income, and they were planning to stay in their property long term. But there are some situations where it won't work. This strategy isn't right for anyone with unstable income, poor cash flow management, or no buffer for emergencies. If you're living paycheck to paycheck and just staying on top of your mortgage, debt recycling is probably not for you because you don't have the capacity to pay down that debt ahead of schedule. You also need to be in a stable position with your property. I had a client this week where the financial planner had spoken about debt recycling, but when we dug deeper, we discovered that they wanted to upgrade their owner-occupied property. In that case, debt recycling doesn't make sense because you're going to reduce your owner-occupied debt, but then when you sell that property, you're effectively repaying the investment loan also, losing the tax benefits and effectively needing to start again. And if you're the type to dip into redraw for holidays or renovations, this isn't for you either. There are also risks you need to understand. There's market risk. Investments can fluctuate. There's interest rate risk. Higher rates affect both your home and investment loan. And there's psychological risk. If you can't handle seeing a higher total debt figure, you'll lose sleep. The example I gave you at the beginning of the video assume that the ETF investments went up. Yours might not. They might drop due to market volatility, and then you're running at a loss. So debt recycling can work mathematically. It can save you on tax, and it can potentially generate investment income, but it's not the set and forget wealth hack many people think it is. It requires significant capital, high risk tolerance, and preferably a high income to maximize tax benefits. Most importantly, you need the discipline to actually use investment returns to pay down debt, not spend them on holidays or cars. Debt recycling is also very effective if you plan to use redraw or offset savings as a deposit on an investment property. But keeping in mind, you will lose access to those funds once they have been recycled. Now, if you believe it's right for you, you also need to make sure you get the structure right. I often see clients who come to us after mixing everything together, and once the debt is tangled, it can be very difficult to fix. The biggest mistake people make is using redraw willy-nilly instead of setting up a proper investment loan split. The moment you do that, you risk contaminating the debt, which can wipe out the tax deductibility and undo the whole strategy. And once that happens, it's a nightmare to unwind. Here's what I mean. Let's say you've got a home loan with redraw. You plan on using the $100,000 to invest in shares. That part is fine. The interest on that $100,000 could be tax deductible. You ask the bank to set up a new loan split with an offset in preparation. But 6 months later, instead of investing the full $100,000, you only invest $70,000 and you pull $30,000 from that offset for a family holiday. Because it all sat in the same account and hadn't been segregated, you now can't cleanly separate which part of the interest is tax deductible. The debt is now contaminated and the ATO won't let you claim the full interest on the $100,000 as an investment deduction. The ATO looks at purpose, not just the balance. If you mix investment and personal use in the same loan, you're creating a mess that's expensive to fix later. Instead, what we do is we set everything up as a separate loan split from the beginning. So going back to that client example, we split their loan into two parts: $600,000 for their owner-occupied home loan and $200,000 for the investment portion. By setting up separate loan splits, we're able to keep things separate from an accounting perspective, which is important for tax purposes. The $600,000 split is owner-occupied debt, not tax deductible. The $200,000 split is investment debt, interest fully tax deductible. This is why you need to make sure your accountant's aware of what's going on and you understand why we have separate loan splits. Often clients will have 3 or 4 loan splits because of the way we're structuring everything. Maybe one for the home, one for the investment debt, and another for a future equity release. There's a good reason for that. It keeps everything clean and separate for the ATO and your accountant. One lender that really stands out here is AMP with their master limit facility. Instead of setting up a brand new loan every time you want a new split, AMP lets you create multiple sub-accounts under a single overarching facility. This means you can add or adjust splits easily as your strategy evolves, whether it's for debt recycling, a future investment purchase, or releasing equity, all while keeping the tax purposes clearly separated. It's far more flexible than constantly applying for new facilities and gives you long-term structuring control. Here's the bottom line: your mortgage isn't just a bill. It's a tool. If it's structured correctly, it can help you build wealth, protect cash flow, and create options for the future. Don't just pay off your home loan, turn it into a tool for building wealth. But here's what I need you to understand. This strategy isn't for everyone. And that's okay. You can still build wealth without it, but if you've got the time, the cash flow, and the mindset, it could help you build wealth faster without working harder. The key is getting the structure right from day one. Even if you don't invest immediately, set up your loans so you can keep personal and potential investment debt separate and avoid redraw for personal expenses. If you're serious about exploring debt recycling and want to make sure it's structured properly from day one, you can find our details in the description below. We'll work with your financial planner and accountant to make sure everything aligns with your broader wealth strategy. Thanks for watching, and I'll see you in the next one.